The budget for the next financial year was welcomed by the equity market as the government made it clear that its priority was to continue pushing growth through a large increase in capital expenditure. The bond market, however, was less than happy as the centre announced a record high borrowing program. Yields on benchmark bonds have shot up to over 3-year highs. We have today the pleasure of hosting Mr. Arvind Chari, CIO of Quantum Advisors. Mr. Chari will share his views on the trajectory for both Indian equities and sovereign borrowing costs going ahead. The US Federal Reserve has announced rate hikes and tapering of its balance sheet in March. Global oil prices remain elevated. The Reserve Bank of India is set to detail its monetary policy statement. Given the global backdrop, there is a degree of pressure on the Indian Central Bank to start the reversal of ultra-loose monetary policy that was adopted at the start of the pandemic. How much more room is there for bond yields to rise, given that this seems to be the perfect storm?
So the bond market. So as I spoke about the divergence, right? So this is where it is playing out. So if you look at the Fed also, the commentary from economists last year, no one was expecting anything in 2022. Now, from 3, 4, some are saying 8 rate hikes, 7 rate hikes in 2000. So that's how quickly things have changed, and that's what causes volatility. From the Indian bond market perspective, it faces two issues. One I said was, where is RBI and what is it going to do, right? So is the stable evolution of the yield curve still a public good? And is the RBI going to again commit itself and say that I will not allow bond yields to skyrocket and I'll manage the bond yields? Of course, it will be higher, but I'll manage it. That reassurance is required in the market, right? Because the market's assumption right now is when the RBI is tightening and they're going to suck out liquidity, how will they do OMO? In fact, they've been doing OMO sales. They've been selling bonds in the last 4-5 weeks. So that reassurance of there is a demand supply gap today, and the RBI will come and meet that demand supply gap either through outright OMOs or through some twists or through some HTM, what kind of dispensation. And that reassurance the market will again need from the RBI. So that's one issue. The second is external demand. There is a demand supply gap, and the hope was that the foreign investor will do it. Now the limits are open. Bond index inclusion is not required for you to get foreign investors. The limits are already open. Foreigners are free to come and buy $200 billion of Indian government bond. That's the amount of limit that's already available. They're not doing it. There's a reason. There are some reasons why they're not doing it. So the bond index inclusion was important from that perspective. And the markets didn't hear anything in the budget in terms of tax changes, settlement issues, regulations, likely inclusion in the index. So that's another uncertainty that the market has, that there is a demand supply gap. So we don't know how much RBI is going to take, and we don't know when the FPI demand will come. In that, the sovereign green bond was I think a good announcement. And see, the global green bond market is overseas, and overseas there are captive investors like a pension fund or a sovereign wealth fund or a bank or a multilateral institution which have mandates to invest in what you call ESG, right, or sustainability ESG. So if the sovereign green bond is decided to be placed overseas, might not be in dollar, they can do a masala sovereign green bond issue. That then taps into a global pool of money which is dedicated for these investments. That will have some demand supply, that can meet some demand supply gap. Otherwise, in the absence of those first two uncertainties, RBI and foreign investment, yields are headed higher because the demand supply gap is reasonable. Unless RBI goes like last time and says GSAT, and then they can manage. But otherwise, if they can't do that and they're hamstrung because they're also they will move from an accommodative policy stance to a neutral to tightening. Those kind of risks, and the uncertainty is also on oil. So if oil spikes, then then the yields are headed a lot higher because that's a clear macro risk. Otherwise, also unless the market gets clarity on these two demand, where's the demand going to come for the excess 2-3 trillion that the government is going to borrow this year? Long-term bond yields will be in trouble, and it looks like yields will go up.
Thank you very much for your time and for a very engaging conversation, Mr. Chari.